You are listening to Keystone's Stock Talk Show, episode 259.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to chat with you again this week. I will kick off the show by building off last week's segment, as promised, with a brief piece on how many stocks you should own in your portfolio and a solution for building that portfolio. To crush our ratings once again this week, Mr. Dunn is back, my co-host, with a brief segment on reviewing and fine-tuning your portfolio, which should dovetail well from my segment. In our Star and Dog segment, Brennan starts with his dog of the week, Victoria Gold Corp, symbol VGCX on the TSX, which cratered around 90% over the past week after the company experienced a heap leach pad incident at its Eagle Gold mine. Is it an opportunity, or should the company be avoided? Brennan will let you know. His star of the week is Netflix Inc., symbol NFLX on the NASDAQ. This week is back to its all-time high hit late 2021. Brennan lets you know why and if it is justified. Finally, Brett answers a viewer question on RE Royalties, symbol RE on the TSX Venture, a renewable energy generation facility royalty and loan provider through non-dilutive royalty financing solutions to privately held and publicly traded renewable energy generation and development companies. The stock is flat on the year, but down substantially from its $1.50 high hit in late 2020, early 2021. Brett lets you know if this royalty payer is an opportunity or a stock to avoid. So let's get to the show. Mr. Aaron Dunn, you're back. The Killer Bees, Brett and Brennan, how are you guys doing? How was your brief vacation, Aaron?
It was
fun.
Good. It was good. Yeah.
Had a good time.
For those who don't know, we went out to the island, went to Ucluelet for a couple of days, and then to Victoria, and it was awesome. I mean, the weather wasn't great, but we got there before the big tourist rush for the long weekend.
Yeah. It's absolutely beautiful there.
I love
anybody
the
who
west coast
can
of
get
the
there.
island. It's just it's very like wild, very rocky, rough, lots of cliffs, and so yeah, we got the paddle boards out. We went on some hikes, saw some orcas, pod of orcas.
That is super cool.
That was pretty cool.
And fairly rare. You saw them from the shore.
We were told it's extremely rare, even for people that live there, that you don't see them from the shore very often. Like obviously, if you're out in a boat and looking for them, then that's different. But yeah, and they surfaced like maybe 4 or 5 times. There's a pod of 3 of them, and you could see like the fin and so that was cool. It was just relaxing, and but I hear that everything basically fell apart while I was gone with the show, and people were complaining. They're like, I'm not gonna tune into the show if it's
Can I ask you guys a random question? What animal on the planet has the highest bite per square inch? PSI. Like jaw strength, essentially.
Maybe a hippo or a shark?
You go with human. I feel like that's a trick question.
Or could it be something we were just talking about?
The orca?
Yes, and it's not even close apparently.
Wow.
Like if you look it up, it's crazy. Like it's 20,000 versus like sharks at like around 4 or 5.
Great white shark.
Like yeah, like just destroys the great white shark. So something random I saw on Twitter this last week, and you happened to. Anyways, I thought it was interesting, and it wasn't even close, which was the cool part. But yeah. All right, let's move on. We don't need to really get into that. We want to hit our poll question to start?
Yeah, our poll has a bit more of a bite, I think. Okay, so our poll question of the week was nice and simple. Yeah, exactly. Amazing joke. That's about as funny as our finance jokes can get. So our poll question was, how many stocks do you hold in your portfolio? So less than 10, that was 37% of our viewers, 10 to 20, 35%, 21 to 30, 16%, 31 to 40, 4%, and 41 or more at 9% of our audience.
I'm wondering if that, I mean, again, our audience would skew towards what we're advising them to do within their portfolio. But I wonder if that includes like ETFs and mutual funds, like in the stocks within those, or that's just saying I own these stocks plus I own 5 or 10 other mutual funds.
Well, I wouldn't include the stocks within an ETF, because otherwise, if you own one ETF, you would have
you could own hundreds.
But I would include maybe the ETF as one holding. That's the way I would look at it.
Likely. Yeah. I mean, that we would look at it that way, but I do wonder, if you had,
I mean, I own one, like in my portfolio, I own one position in an S&P 500 ETF. It's a smaller position, but I own it. If somebody were to ask me how many stocks I have in my portfolio, I wouldn't say, 520.
20 plus 500. That's what you say. 520.
If we wanted to be specific, it would be something like equity securities.
I would only start, I would only start considering that if like you own 20 stocks or 30 stocks, but like 80% of your portfolio was in ETFs or something like that. Mm-hmm. And I would say it starts to be, what's the point of that, doing it that way? But I mean, that's just, what I would say if it was positioned that way. But if it was like you're saying, if you own 20 stocks and you happen to own like a 3-5% position in an
it's
ETF.
One position basically.
Exactly.
Is the way that I look at it.
That makes sense. Okay, how would you guys answer that question?
I did vote in it, and I think I own 16 stocks in my portfolio, so I was 10 to 20. That's where I voted.
I think I'm actually at 16 as well right now.
Wow.
Yeah,
matching.
Mine in the range of 20 to 25.
A portfolio for a client. I guess this was a couple months ago. It had upwards of 150 stocks.
Yeah.
And that's really when we talk about, Ryan's going to talk about what our target number of companies is, but that's really the type of thing that we're trying to avoid is once you get past a certain number, and Ryan will get into this, you may as well just own an ETF.
Yeah.
Because you're basically becoming the market, except that you'll probably get lower returns because your portfolio is much more complicated to manage when you have, 50, 100, 150 individual stocks.
Now there's no point in doing my segment. Aaron just did it. It's over.
Right.
We're done.
Now you know how I feel.
It's true. I know. No, but that's dovetails well into what we're going to talk about next. And I might as well share my screen. Let's get to it. We got a lot of content to do today.
More of your segment away.
You've done it all. Well, then I don't have to do it. We're good. Move on. So I'm going to look at how many stocks you should own coming out of the segment from last week, as promised, and a simple portfolio build, the way that we recommend you build your portfolio. Let's start with what not to do, and we kind of just talked about this in this segment. That is something we call mass diversification. It's kind of the broken model. This is the basic model most Canadians deploy through their big bank advisors. There are some advisors that do it differently, but it's still by far the most commonly used method. It includes a mix of 5 to 15 plus mutual funds and ETFs. We see this type of portfolio from clients when they send us their portfolios on a daily basis. Now, each type of fund in this under this model owns, or ETF owns, roughly 50 to 150 plus stocks. Each fund then holds too many stocks and really mirrors the market return or the segment return they follow, but they underperform due to the high fees that they're charging you. And the portfolio underperforms, particularly under this model, when you include the roughly 1 to even 2% advisor fee that we've seen on some of these type of portfolios. Of course, we were talking about just one fund there. This is just one of many 5 to 10 to 15 plus funds that you own. This is extreme over diversification for those trying to beat the market, but I wouldn't just take my word for it. Let's look at some of the best investors of all time. Warren Buffett says diversification is for protection against ignorance. It makes little sense if you know what you're doing. To hammer this point home, I'll reference Bill Gross next. He co-founded PIMCO, managed one of the largest funds in the world for decades. He said, do you really like a particular stock? Pick 10% or more of your portfolio on it. Make the idea count. Good investment ideas should not be diversified away into meaningless oblivion. So your question now should become, how many stocks should I hold in my portfolio? Well, let's address that. According to modern portfolio theory, you come very close to achieving optimal diversity about adding about the 20th stock to your portfolio. It's actually just under 20. So diversification, it makes sense to a point. Generally, we don't want you buying 2 to 3 stocks, even if we or you have put in all the research in the world. This is too much company-specific risk. As an extreme example of this, if you were to hold stock in Tesla, that would be considered a CEO-driven company. If its CEO, Elon Musk, heaven forbid, were to pass away, that would likely have a dramatic negative effect on the stock. Of course, the funny thing here is since Elon bought Twitter, this is becoming less and less valid. I'm kidding, but you kind of get my point. You cannot mitigate away this company-specific risk. If Tesla is one of 2 to 3 stocks you own, if it's one of 20, you can help handle it. It can help allay that company-specific risk in your portfolio. On the flip side, there's absolutely no point in buying 50 to 100 plus stocks and creating a complex fee-heavy portfolio that mirrors the market. This is what we like to call, wait for it here, boom, diversification. As Brett said, finance is not funny, but that's about as funny as we have it for you here today. How do we recommend you build your stock portfolio? Well, we say we want you to take control of it. If you want to beat the market, you cannot just be the market buying 10 to 15 plus equity ETFs or mutual funds. If you just want to perform at the market, you can probably buy 3 low-cost ETFs and call it a day. If you're trying to beat the market, we want you to create your own simple equity portfolio, building under a model that we would call focused diversification. And how do you do this? Well, this is key. Build a 15 to 25 stock portfolio gradually over a 12 to 24 month period. Do not buy all 25 stocks in the first week, month, or even year. Traditional advisors will buy, like I said, 5 to 15 plus, ETFs and funds right when you step in the door. This crystallizes your entry point. If you're near a top and face a significant decline, it can take a significant amount of time to recover if you face a significant correction. Remember, if you have a 50% loss in a security or heaven forbid in your portfolio, you need 100% gain to get you back to just even. While no strategy is perfect, building over a 1 to 2 year period reduces the risk of short-term exposure to short-term market corrections. This is a strategy we have employed for decades with clients. It provides you flexibility to add to new positions as new opportunities become available, and they always do. The process, if you became a client with us tomorrow, or you want to start building your own portfolio tomorrow, you want to start with 3 to 5 initial positions. What we also provide for if you have that other part of your portfolio in cash sitting there, you can use Keystone's quarterly cash ETFs report, where you'll find in that portfolio currently paying about 4.5%, individual options to park that cash. We update this quarterly with recommendations to get you paid the highest dollar on the cash that's on the sidelines. All clients have access to this report. Then you can add 2 to 3 new stocks per quarter every 3 months as new information and research is released. In practice, this is an example of what a portfolio structure of a portfolio using our research would look like, that focused diversification strategy. Essentially, 7 to 10 stocks deployed in our 3 core areas of research: our Canadian mid to small cap growth stocks, core Canadian dividend growth stocks, and core US growth stocks. I put together a simple allocation example here. We can see a $500,000 portfolio, 20 stocks with equal weighting. So that just means take the 500,000, divide by 20, you got 25,000 in each individual security as your full position to start. So how impactful? We talked about last week how 2 to 3 stocks can be tremendously impactful if they are great stocks in your lifetime. Just to show you an example of this once again, how impactful one great stock can be and why, we recommend building a portfolio in this methodology with focused diversification. This is a $500,000 portfolio. If you invested 15 years ago when we recommended Boyd on an equally weighted basis, so if you had 25,000 in Boyd at that time, today the stock would be worth $3.18 million. Just one stock is worth nearly 7 times the entire original portfolio. All other 19 stocks could have gone to zero. Of course, that's not what we're seeing happen in our portfolios, and we wouldn't see that going forward. But this portfolio would still be in excellent shape. Of course, we are also looking for growth in a solid percentage of the other 19 stocks as well. But it shows you the truly amazing power that a great stock can have in your portfolio. And you can see here the effect that as well, the returns are even better if you use Hammond Power as an example here. So hopefully that now gives you an idea of how many stocks you should own and how to build that simple portfolio. In our webinars and seminars that we do at least twice a year, we have far more detail on how to build that, but I thought I'd give you a quick overview of that today.
Yeah, I think that it's great. Just to go over to give people an idea, another thing that we talk with clients about is just the layering into positions and how it can be beneficial. As again, it's very difficult to actually time the market if we like a business, but think that maybe there are near-term headwinds. Again, maybe starting with a half or a quarter position, and I like the analogy where I ended up writing an article a few years back where, just like drinking a freshly brewed hot cup of coffee, you can avoid getting burnt by just taking a few sips at first rather than, swigging it all down, essentially. I really like that analogy where it allows you to be nimble, essentially kind of mitigate both the business's operational risk and also the price action risk in the market. But again, giving you some exposure. Like I wrote in that article, I ended up getting, burnt by trying to time on Expel. Again, this was years back. I was definitely more of a green analyst. I still am to some degrees, or to some degree. These guys would probably agree with that. But, I was waiting for Expel to pull back to $14. If I would have just even put, a couple grand in it, which would have been a half position for my portfolio, I would have, went 3x, 4x on that money rather than sitting on the sidelines and being a sad investor while I watched the stock continue to run. So that is just on top of what Ryan was saying, another thing that investors can look at when they are building their portfolio. Maybe taking a quarter or a half position, depending on the fundamentals of the business or what we're anticipating from the business itself.
Yeah, I agree. That's one of the things we talk about, and we recommend to clients when we make a recommendation on a stock. There are times where we have a half position, quarter position, whether it be a buy, that sell. At times, we had a company that we recommended in the fall that exceeded our expectations, was up about 140%. In about a 6-month period. And we had originally, our original thesis behind it was if it could do that over a 3-year period, and it actually exceeded that, this would be a good, it's not that it's a bad company, but, we took half our position out, and now we have still a full position, because when a stock goes up more than 100% on your original position, you've more than doubled. You still have a full position, but you've taken all your initial capital risk out, and now we can just feel comfortable holding that company for an extended period of time as long as they continue to deliver. Yeah, and with your analogy with the cup of coffee, as long as you know that cup of coffee is going to be a good cup of coffee, you can have that initial small sip and get involved. It may be too hot, like the stock price may be a little bit too high, but you don't want to be too cute.
Exactly.
And if you found a really good company, even if you think it's slightly overpriced, it's probably good to start nibbling away on it.
And I was trying to be too cute on a great business, Expel.
Aaron always says you are pretty cute. So
yeah, that's what he does say.
And just really tying in the,
of course, being very sarcastic.
Yes.
yes. That's fair. Go on. Sorry, Brett.
Yeah.
Were you going to call me cute too?
Yeah. Unfortunately not. That shirt doesn't do it for me today.
Yeah.
But
this has escalated quickly.
The On the really reweighting strategy and diversification, the benefit of you doing yourself, you're able to have that approximately equal weight portfolio or near equal weight, depending on your stock price movements. That is more diversified. So even if you're looking at ETFs, you'll find equal weight ETFs are more diversified. So if you are doing something for diversification, when you're buying these 100 plus, let's take the S&P 500 for example. Right now you have 32.4% in information technology. So those are your big players, your Microsofts, your Apples, your Googles, and so on. That's in that category. That creates concentration within that sector, which actually lowers diversification by your normal market weighted strategy. Versus equal weight, you don't have that. But the issue with equal weighted ETFs, since they're constantly balancing perhaps that 50, 100 stocks or more, the fees end up accruing quite quickly. And since they are ETFs, they're not really thinking about the individual companies. You still have those poor performers. And since those poor performers, they lower in price over time, and then they're re-equal weighted up higher, you end up getting a higher weight of poor performers. So you can't really do it in an ETF form where if you're doing individually what we like to do on a somewhat equal weighted, we're not going to say exactly equal weighted, you really can get that diversification benefit while you're also getting that concentrated returns. Yeah. You get best of both worlds in reality, where ETFs, you can't really do that due to how they function.
It's a good point. All right. You're going to dovetail now into, or you're going to kind of build off of what we're talking about, I believe, Aaron, and then you're going to talk about, how to rebalance a portfolio as well.
Right. So the segment that I'm going to do is actually based on one of the comments made from our poll. So our poll, once again, was about how many stocks individual investors hold in their portfolio. And then one of the commenters mentioned that they hold too many and they weren't sure how to pare that back. So one of the things that we often do for investors is we'll take a look at their current portfolio and just provide them with general guidance on how we see it structured and, generally speaking, some improvements that could be made to the portfolio. One of the big things we see is just too many stocks. So as Ryan said, 15 to 25 or 20 to 25 individual companies in your portfolio. That's a target. It's general guidance, but we see portfolios with 50 individual stocks, 100, even 150 I've seen recently. And these portfolios are just way too unwieldy, difficult to manage. So one of the things that we always say is that it should be part of your regular investment process to conduct a portfolio review periodically. And this should probably be done about every 6 to 12 months. And this is really where you just go through your portfolio, you look at your holdings, and you determine if your portfolio is still aligned with your goals and if there needs to be any changes. So in terms of fine-tuning stock positions, this is when you would look at your individual stock positions, potentially as well as your ETF and fund holdings as well, and just determine if there are any changes that need to be made. So some of those may be like rebalancing based on the sector or geographic weightings in Canada relative to the US, rebalancing stocks that have done very well, like Ryan had mentioned, Boyd and Hammond, companies like those, and also removing companies, either because there's been a fundamental change in the business and it's no longer something you consider investment worthy, or because your portfolio has just become too unwieldy and now has too many companies. So this is a challenge for a lot of people because they don't know exactly how to do this. So I figured that I would just go through the process that I take to look at portfolios and provide my general guidance on that. So there's a few steps here that I take. And the first thing that I always do when I look at a portfolio is I calculate the weightings, right? So I want to know how much percentage-wise is allocated to each individual sector. I also want to know what the geographic breakdown is, primarily how much is allocated to Canadian stocks versus US stocks, potentially international, if there's any in there. And then how much is allocated to each individual stock holding. So I'm going to focus really on the equity or individual stock portion of the portfolio. A lot of people will have bonds, will have ETFs, funds. Really, though, at Keystone, we're focused on the individual actively managed portion of the portfolio. And that's primarily what we're talking about here. So calculating those weightings really gives you that bird's eye view of your portfolio, and it summarizes it in a way that will help you make good decisions going forward. So once you have those allocations calculated, you want to look at what your sector weightings are. Identify which sectors you're over or underexposed to. So here in Canada, what I see a lot of is overexposure to energy. Sometimes I'll see a portfolio might have 50% or more in oil and gas stocks. I've seen upwards of 80%. Financials as well, another area of overexposure in Canada, just based on the way the Canadian market is constructed. So one of the first things that we would look at is just targeting, well, which areas of the market am I overexposed to? And these are probably the areas, if I'm going to reduce the number of companies in my portfolio, that I'm going to look at first. Not necessarily that all the reductions have to be in those sectors. You may want a strong exposure to that sector, but having too many companies, being too diffuse about it, is not necessarily the best way to go. So target reducing the weighting to overweighted sectors. And then conversely, I would say if you're underweighted in certain sectors, which in Canada would probably be technology, look for opportunities to add. We also want to look step 3 at the country weighting. So this is primarily going to be what percentage of your portfolio is in Canada and what percentage of it is in US stocks. Canadian investors are very home country biased. I guess you could say that about really any country, but in particular, we're right beside the US market here, geographically and otherwise. And the US market, we've done segments on this before. It's just a far superior market in terms of where they're exposed. So technology is a major part of the US market, whereas in Canada, technology is a very small sector. There are far fewer opportunities. And the US market, obviously much bigger, but just better diversity of opportunities. So we believe that to set yourself up for success as a Canadian, you need to have strong exposure to the US market. So what is that exactly? Well, it's everything is going to be investor specific, but we think most Canadians could probably have 30% of their stock holdings in US companies, even up to 50% plus of their stock holdings in US companies potentially. This is just going to depend on the individual, but in some cases I will see 0 or almost 0 or 10 or 15%. And in those situations, one of the things I would advise is to increase the exposure to the US. Now, this could be done with individual stocks, such as through Keystone's US Growth Stock Service. It could also be done with S&P 500 ETF, but one way or another, it should be done. Step 4 would be to review the individual stock weightings. And this really comes down to those portfolios that have too many companies, too many individual companies. So really, when we look at investment strategy, if you want to be widely diversified with your portfolio or a portion of your portfolio, that's when you want to buy an indexed ETF. That gives you automatic diversification across the entire market. And it's easy to achieve. But a lot of people, when they're buying individual stocks, think that the point is to build a diversified individual stock portfolio. And that's really the wrong way to go about it, because with individual stocks, you want to be focused. The whole point of investing in individual companies is that you are identifying attractive opportunities whereby the risk-adjusted return is superior to the overall market based on yours or somebody else's analysis, somebody who you trust to perform good analysis. So you want to be focused with your individual stock portfolio. And that's why we're saying, the 15 to 25 or 20 to 25 stocks. Now, as a general guideline, some people say, I have 30 stocks in my portfolio. That's not necessarily breaking the rule. These are general guidelines. But once you start getting up to that 30 to 40 plus, you really have to look at trying to pare the individual stocks down. And if you want diversification, go and get a indexed ETF. Now, in terms of what a portfolio would look like, an individual stock portfolio would look like with respect to individual company allocations. So if we were to say 15 to 25 stocks, individual stocks is the target, then that would put an equal weighted position at about 4 to 6% of that portfolio per company. So if, for example, that was $100,000 portfolio, that'd be 4 to 6,000 per stock, right? Now, some positions will be overweighted. There will be a select few companies, for whatever reason, that you will have a very high conviction and you will want to overweight. there you're maybe going 10 to 12%. In some cases, you may want to underweight companies. You may like the business, the growth prospects, but maybe it's higher risk or for whatever reason. So a half position is going to be 2 to 3%. A quarter position then is going to be 1 to 2%. But really the core of your portfolio, most of your holdings should probably be in that equal weighted position range. And then some will be overweight and some will be underweighted as well. So in the review of your individual stocks, there are a few questions you have to ask. And one of the questions that we get a lot is, well, when do I rebalance my winners? Like if I have a winner, something that has performed extremely well, I still like the company, when do I know when to sell? And the thing that we always say is, it's not an all or nothing decision. Just because you sell a company doesn't mean you have to sell 100% of it. You could sell half, you could sell 25%, 10%, 5%, depending on the company. But generally speaking, if you have a company that has performed extremely well, once that position size starts to exceed the 15 to 20% range, just as a general guideline, you should look at some modest rebalancing, which essentially means reducing the position. And I'll just give you a really quick example, Hammond Power that Ryan talked about in his segment. It was re-recommended actually in 2017 at 726. It had hit a high this year of 150 in 2024. So if somebody had purchased just a 5% weighting in Hammond Power in 2017, that was 5% of their stock. Even if the rest of the portfolio from 2017 to earlier this year in 2024 doubled, Hammond Power would still be 35% of that portfolio. And that would be likely what we would consider to be excessive weighting. Now, of course, in this case, you are sitting on a huge return. You're kind of playing with the casino's money, so to speak. But, really that's an opportunity for you to sell pieces of the company, maybe smaller pieces as it's appreciating beyond that 15 to 20% total percentage of your portfolio, just to lock in some profits and rebalance the position and then recycle that capital into other companies. Well, what about the underperformers? Now, sometimes there are underperformers. When do you know when to remove those? Well, really the way that we look at it here is you have to identify the reason for the underperformance. So there are companies that have great long-term growth profiles, but they may misstep for a quarter or two. This is what you would refer to as a temporary loss of capital. This is a term, I believe, from Warren Buffett. He's very specific in terms of separating temporary loss of capital from permanent loss of capital. Temporary loss of capital has to just do with general market volatility, maybe a short-term issue that a company is facing, or for some reason, the popularity with investors has declined in the near term, but it's still a great company fundamentally. And the reason that you originally purchased it still exists. So you may purchase a company because you're looking to hold that for a 5-10 year time horizon. There may be a misstep, maybe a change in investor sentiment. The company may not have performed well, but fundamentally, it's still the same business. And all of those reasons are still intact. So that may be a reason to keep the company. Whereas if there has been a major fundamental structural change in the company, then you may be facing a permanent loss of capital. And that's when you really have to review, is there a concrete likelihood of recovery? Like, can I really kind of quantify my rationale for why this company should recover? Or am I just holding it on out of hope that it's going to recover? That's the question you have to ask yourself. And as well, how does the company fit with your current investment plan? So if there has been a major structural change in the company and those original reasons that you purchased it no longer exist, that may be a reason for you to decide to remove it from your portfolio. And then also when to remove small positions. So this is one of the most common things that I will do, or one of the first things I will do when looking at a portfolio that has too many companies. We've already calculated all the individual stock weightings. Most of the portfolios that have excessive numbers of individual stocks, so say 50, 100 companies, 150 companies, they have a lot of companies where the weighting is extremely small. It may be, like 0.2%, but well less than 1%. So as I'd said before, the core of the portfolio, the majority of the stock should be close to equal weight, 4 to 5% weighting, roughly. But anything that's under 1%, you really have to reconsider why you're holding the stock. If you don't have enough confidence in that investment to have a 1% allocation, then you probably just don't have enough confidence to have any position at all. And even if it's a very small, if it's like a 0.1% position, even if the stock performs very well, it's not going to move the needle of your portfolio that well. So one of the things that I'll say, if you're sitting there with a huge number of companies, you want to start paring it back, you're not sure where to start, calculate the individual stock weightings and just consider getting rid of anything that has a less than 1% allocation or weighting in your portfolio. So really just one of the things that I always want to stress whenever I'm talking to an investor, every investor is completely different. So this is not specific advice for individuals. This is really our general guidance. And these suggestions can really be modified to the individual investor based on your resources, goals, risk tolerance. I will also say that when people come and they know they need to make a major portfolio adjustment, just like we say, build a portfolio gradually over a period of time. Adjustments to portfolios can also be made gradually. Now, some of those adjustments, like holding really bad companies or being extremely overweighted in certain areas that you don't want to be overweighted in, maybe you want to make those changes more quickly, but don't feel that you have to make every change on day one. It can be a gradual change. Indexed ETFs, again, if you're looking for wide diversification for your whole portfolio or for a part of your portfolio, that's where indexed ETFs come in. But individual stock portfolios, they should be focused. Now, you can always have some ETFs for diversification and then an individual stock portfolio to outperform the market. But really, individual stock portfolios need to be focused, and they're not for wide diversification. That's what you would use an ETF for. And that concludes.
I think it was a good summary. No, and I think it. We talked about how many to deploy in a portfolio, how many stocks, how to build that, and now you've got to look at rebalancing and how. I mean, one of the things we deal with on a constant basis is clients coming to us from other advisors who have put them in 50, hundreds of stocks, ETFs. And it's how do you cut those? Which companies should be cut? I mean, it's really, like Aaron said, if you just have a 1% holding, we just looked at a portfolio the other day that had about 40 stocks that most of those stocks were 1.5% or under of the portfolio. And, the client didn't know why they were holding them to one. And, fundamentally, we're just going to look fundamentally at those businesses as well. And if they don't pass our test, we're not going to put them in a portfolio. But if you don't know why, if you're just looking at it yourself, you don't know why you're owning that stock, and or if you did know why originally and it's not, you can't still apply that same rule to that stock, it's a good way to cut that out of your portfolio. But I think the thought that you have to do all of those changes in 1 week or one fell swoop at one point in time is just like, we don't want you to make all those purchases at once. You can make those adjustments over a period of time. There's some simple changes you can make right away, day one, but then there's probably some of those changes will take 6 to 12 months.
Yeah, and I think it was just a good, thing to like cutting your losers. Like it's a market of opportunities, not just a stock market. So again, if all of a sudden one stock that you purchased isn't providing, quite the opportunity that another stock is, why not replace it in your portfolio? So again, I think that people tend to, not sell or cut their losers because again, they're just wanting and hoping for a stock to come back when the fundamentals, there's a reason why the stock is went down. So I always think that is a good point, that it is a market of opportunities, and to stress that to investors.
And it's kind of you're cutting loser on price, not only on price. If a company somehow was up, 20%, but not performing to your expectations fundamentally, you're cutting that from your portfolio, right? And you could have, Aaron said, you could have a stock 20% down, 50% down. It's performing well fundamentally, so you hold that company. You're not cutting just because of the price loss. Yep. You're cutting because the business or the management team is not executing on your original expectations.
Yeah, and I'll just go a bit further on what you guys are saying with probably the most common that retail investors or common investors the issue they have managing their own portfolio is dealing with loss aversion, or if not, it's one of the top. It's because losses hurt more than what it feels good to have a gain. So if you had a $500 loss on a $1,000 position or a $500 gain, that $500 loss, so a 50% decrease in your portfolio, feels a lot worse than that 50% gain. So people always really attribute that to it's a temporary drawback. They aren't recognizing it that it is a permanent loss of capital. Like Aaron was saying, you really need to be critical in thinking between that temporary loss versus permanent loss. And a lot of people will be dishonest with themselves because they don't want to realize it is a permanent loss of capital. And that's when you end up with those people will say, oh, it's not a loss until you sell type of thing. They end up being that big holders for 5 or 10 years. And it's just a waste of money at that point because you have hit a permanent loss of capital at that point.
Yeah. Really goes into the psychology behind investing too. And it's part of it that we don't talk about as much as the fundamentals, but it's something maybe that we should talk about behavioral finance a little bit more going forward. All right. I think that closes those two segments off. Brennan, you've got a star and a dog of the week. You're going to start with the negative, I believe, and end on a positive. That's what you love to do, right?
Yes, sir.
Victoria Gold Corp, symbol VGCX, had some terrible news last week, and it kind of shows you the cautionary tale of investing in resource type companies. You can have a company that was seemingly operating decently, and then they had an accident.
Yeah, exactly. So I'll go over
that.
the dog here, and then I'll open it up for questions before we go to the star, or not questions, but just comments, I guess, unless you guys are going to drill me with some questions. But anyways, yes, the dog of the week is Victoria Gold Corp, VGCX on the TSX. The stock is down approximately 20% in the last, trading day, and down about 90% in the last week, where it now trades at a price of about 83 cents and a market cap of about 72 million. And the question on everyone's mind is what is driving the stock substantially lower in such a short amount of time? Well, on June 24th of 2024, Victoria Gold experienced a heap leach pad incident at its Eagle Gold mine in the Yukon, which is its only producing asset. And the incident suspended the mine's operations, damaged infrastructure, and potentially leached cyanide solution into the surrounding environment. Now, there is a lot of speculation what this might mean for the future of the mine, which employs about 500 people and could mean a prolonged shutdown or possibly even the end of the mine, which some articles have been talking about. Now, in Q1 of 2024, the mine produced about 29,580 ounces of gold. And in 2023, they did about 166,000 ounces. And production at the Eagle Gold Mine for 2024 was estimated to be between 165,000 and 185,000 ounces of gold. So they were projecting some good growth in ounces for the year at the midpoint, which of course is now no longer expected. And on top of this, the company has about 196 million in net debt on the balance sheet, which is certainly a concern as its revenue and cash flow are now idle. Now, this is something that we discuss with our clients all the time, as when someone decides to invest in a commodity-based business, they are faced with the additional risk factor of a volatile commodity. But on top of this, there is heightened operational risk in the mining industry as things tend to take a lot longer, and there can be many disruptions and incidents, such as the recent heap leach pad incident at the Eagle Mine, which has made Victoria Gold our dog of the week. Now, do I think that this is presenting an opportunity given the incident? Personally, not at this time. I think when the dust settles, there will be a plan to get the mine back up and running. But seeing the debt that needs to be serviced, along with the unknowns of when and if the mine will get back up and running, and potentially any penalties that the company may face after the investigation is concluded, I think that the risk outweighs the potential reward at this time. Any comments from you guys? Or can I keep trucking along?
You can probably keep trucking along. I think it's fairly self-explanatory on Victoria Gold what happened, and Yeah, I mean, it's not an opportunity in our minds at present.
Yeah, exactly. Okay, so
too high risk.
Yeah, exactly. So my star of the week is Netflix, NFLX on the NASDAQ. So the stock is up about 5% in the past month and 43% over the past 6 months, where it's currently trading at a price of about $675 per share, which is essentially back at its all-time high reached in late 2021. It has about a $290 billion market cap. Now, obviously, Netflix doesn't really need an introduction, but if anyone doesn't know, it offers entertainment services such as TV series, documentaries, films, and games across various genres and languages. Now, let's take a look at what is driving the increase. So first and foremost, the company's strong financial results are driving the share price higher. So first here, average paying members in the quarter were up 14% year over year to about 265 million. Total revenue grew about 14.8% year over year. GAAP EPS or earnings per share was $5.40, an increase of 84% compared to Q1 of 2023. And I will note that Netflix does have net debt of just under $7 billion, but this debt is certainly sustainable considering the company produced free cash flow of about $6.91 billion in the last 12 months. Now, number two for what's driving the share price gains is that management increased the company's fiscal year 2024 operating margin guidance from about 24% to 25% and now expects revenue growth to be about 13 to 15%. Now, a concern many analysts have voiced in the past with Netflix is that it wasn't going to be able to continue its strong track record of financial growth. But management indicated that on top of providing quality, engaging entertainment, looking forward to 2025, the company is looking to scale ads to be a more meaningful contributor to the business. So it is going to be interesting just to see how that trends with the financials. And lastly here, number four, what's been driving the share price. Netflix has been doing a great job at engaging subscribers with the roast of Tom Brady reaching the largest ever weekly viewing total for a one-off special. And on top of this, Netflix is looking to host the Mike Tyson versus Jake Paul boxing fight, which is now expected to take place in November of 2024. So I think they are in a great position to benefit from more one-off live specials, especially potentially dabbling into more sporting events such as, boxing. So all in all, I think getting back to its all-time highs is justified given the strong fundamentals, healthy growth in users, and optimistic outlook for the business. Now trading at about 46 times trailing EPS. I mean, that's still, maybe on the pricier side. However, but like to put this into perspective, this is much lower than the 80 times trailing earnings that it was trading at in 2021 when it last reached its all-time high. So as such, Netflix has taken our coveted spot of star of the week, and it's going to be interesting to see how their fundamentals or financials continue to trend here over the coming year and into 2025, especially when they start, trying to propel their ad revenue, and we will see how they roll that out.
Yeah, I mean, I think it's done well to rebound. I think it's a little bit pricey based on revenue growth is slowing.
Yeah.
So, I mean, we have to factor that in. It's 35 plus times, this coming year's earnings. That's a high rate for revenue growth that is slowing. And compared to some of the other large, it's in the tech sector or the, it is not net cash. I mean, it's no problem servicing its debt, but it is as opposed to like the Microsofts or the Alphabets of the world, the huge net cash positions there. I mean, different companies, obviously, but you're paying a significant premium once again, and the growth rate is slowing. Certainly a better company than it was the last time it hit, that high, but you're paying the price for it right now.
Yeah, exactly.
I would say that like where we saw in the 2010s to 2020 or so, we saw that disruptor stage, that ultra growth stage, and that's why it was getting that 50 to 100 times valuation, because that was expected to continue. And then finally, once it drops, you see that 70% drop in price within the few months once it gets revaluation into a more mature company. Because during that decade, we saw they were able to access third-party media, so they were But now you have competition. Disney pulled like their back library from Netflix. You saw Paramount come on the stage and all the Hulu in the US, even though they were around. Netflix started to rely more and more on their original productions, and now we're seeing them go on to those one-offs like Brennan was saying, and I think that is what they're looking towards, is because then they do get like the kind of pay-per-view, what used to be pay-per-view audience into Netflix subscriptions, and instead of just relying on a backlog of library like they were a decade ago, because it wasn't until I think 2013 that House of Cards, that was their initial production, which might have been earlier than that, when they started to do their initial productions that weren't relying on third parties. And we saw during that decade, that's when they really grew. And now you're seeing another stage in the business cycle, really, of maturity, to where they are needing to branch out into pay-per-view. And they've been looking to look into video games as well, but I don't think that's been going as well.
Yeah.
And so you're really seeing a shift in company maturity, I would say.
Yeah, it is interesting too to look at Netflix this week, because there are streaming merger talks that have kind of been in the rumor this week. Paramount Global is in talks to merge its Paramount Plus streaming service with another platform. That deal could spark new streaming partnerships potentially. Warner Brothers Discovery is interested in combining Max and Paramount Plus, aiming to better compete with Netflix and Disney platforms. Earlier this year, Warner Brothers Discovery discussed a full merger with Paramount Global, but those talks stalled. So a merger could offload Paramount Plus's losses by sharing ownership. Warner Brothers Discovery's streaming platform made about $103 million in 2023, while Paramount Global had a loss of $1.67 billion. So there's, we're talking about Netflix right now. There's, a lot of activity going on in that streaming sector right now. So we'll continue to monitor that.
Yeah. And I guess the last thing that I just want to say on it too is, getting back to early or late 2022, early 2023, the stock was trading with a trailing PE of, closer to 28 times. So, you can definitely see that investors were, maybe bidding the stock back up, trying to, get more of an attractive price in, a good business. But like Ryan said, growth is slowing. So that is certainly something to keep an eye on. Yeah.
Good. Okay. Well, we're going to have our final segment. It's Your Stock, Our Take. We're taking a question on RE Royalties, a company that we have looked at in the past, met with management at a couple conferences as well. We got another question on them, and Brett's going to update how RE is progressing.
Yeah, this is a company we've been following both on the podcast. I think we've done a couple of segments, or Brendan's done a couple of segments on it before as well. We've talked to them in person. Once before with me, and I think you guys had prior as well before that. So RE Royalties, symbol RE on the TSX Venture. It's a renewable energy generation facilities royalty and loan provider through non-dilutive royalty financial solution to privately held and publicly tradable renewable energy generation development companies. Effectively, they lend money in various manners to help at renewable energy production. The company's portfolio is comprised of solar storage, wind, hydro, and biogas, and its assets are located, or the underlying loans are located in Canada, the US, Mexico, and Chile. The company is a strong dividend payer, at least as far as the yield goes, at this time at 8.2%. The stock, however, has been trading flat over the year to date so far at 49 cents. It's actually 0% at the time of recording. But however, if we zoom out a bit, it's fallen about to a third of the price it was seeing in late 2020 and early 2021 of $1.50, and now we're at the 49 cents. So it's fallen quite a bit. Part of that you can just directly attribute to interest rates have increased, which makes these dividend royalty payers less attractive. But as well, we are looking into the company a bit more. So let's look to see if the company really supports the current price, or if there's more room to grow, or if it's going to fall a bit more. So as RE Royalties is a financing company, it's really important to look at how the investments are structured. The company invests in both pre-operational and operational assets, so things that are in construction or that are already operating and producing some sort of revenue or producing something. The pre-operational matters particularly for revenue. output-based royalties, as the company is not receiving the payments from those royalties during that initial period, as there really is no output. You can't have a power-producing royalty that's producing no power give you a royalty that's based on power production. The company does, however, do a mix of royalty financing and loans for the majority of their deals. The difference is royalties will be based on some sort of output, whether it be revenue or dollar per watt. If you look at something like oil gas outside of RE space, it might be they get, for every 100 barrels, they get the rights to 2 of those barrels, something like that. Whereas loans will be independent really of that output, normally being a fixed or variable interest rate over time with a potential repayment of the principal at the end, or that principal could be mixed into the payments as they go. Effectively, there's a bunch of ways you can structure this, but royalties really are based on output versus loans. It's more of a traditional financing option. If you think of a mortgage, that'd be more like the loan in these cases versus royalty. That's completely different. As well, there is their mix of royalties and loans, and that really matters for RE royalties because it comes into their finances. So really the reason why I bring this up is 90% of the revenue and finance income that RE receives is classified as finance income. So that's income from loans. 2.4 of the 2.6 in the last quarter is classified as loan income. So that's only 200,000 not being that royalty income. So when your name is royalty, but only 200,000 is being classified as royalty, you really need to look in why that's occurring. The company has been structuring most of its deals as royalties, as a part being royalty, but it really needs to come online over time if the once the loan term matures and then the assets continue to perform. So if we look at the last quarter, for example, they closed out 3 deals with royalty or partially royalty structures, and as well as loans embedded in the same deal. So this is where what I mean is you need to look at, is it a loan, is it a royalty, or what the mix is. So going through the 3 deals, Clean Communities Corporation is a 4 megawatt solar construction project in Alberta, which is comprised of a $1.7 million loan over 5 years, and then after that a 5% 20-year royalty payment afterwards. Revolve Renewable Power Corp, a 23 megawatt hydro and wind in BC and Alberta. Once again, we see this hybrid royalty loan structure with a $4 million, a 36-month loan. Then during that time, they have a 0.5% royalty, but then after the loan, it goes up to 1% after that loan repayment. Then the last addition during the quarter was Revolve DG, a $415,000 loan for rooftop solar for a Mexican food manufacturing business, with once again a royalty on top of once the loan's repaid, they get 5% of the revenue received from this operation for 15 years. So as you can see, despite its name, they're largely involved in loans as well, in effectively every deal they make. When we talked to the CEO, I think it was last October, he said 80% of their deals were this hybrid. So I would likely think that it's even increased since that, as all the deals that they are bringing on are this hybrid structure. So now we can really look at the last quarter and understand why the majority of its top line is generated from the finance income, despite the company's name. It does have royalties that will come online in the future. We do see those construction projects, or ones that they get the royalty after the loan is repaid. So that can be 3 or 5 years down the line. And I will add, the CEO did say he personally believes that more of their revenue should be classified as royalty, but the accountants disagree. And that's why you see this. But when we look into it, we do see that hybrid situation, and it really comes down to how you want to interpret it. If you do count more of that as income or finance income or loan income versus royalty payment, because it is structured in the future as a royalty. But at this time, we can really see how the accountants treat it, and it is firmly in the position of they're treating it as loan income at this time. But despite that, the company did have a nice overall increasing of the overall financing income to $2.6 million from the prior year's 1.8. So that's a strong increase in what they're receiving in between the revenue and the income. Moving down the income statement, the company does, however, have a significant financial expense as it uses green bonds to finance its investments. Green bonds are like a normal bond, but they're limited to certain types of investments in the green space uses. But they also offer, since they are restricted, they're given a lower interest rate, so the company does benefit from it. And particularly RE Royalty, I will say they do benefit greatly from this, because they're not really going to invest outside of the green space, so they're able to reap the rewards from the green or the green rate. So it might be a few percent lower, while still just investing in green projects, which they would have otherwise. But overall, the company did have finance expense of 0.9 million, with outstanding green bonds of 36.6 million. So that's their significant debt on the balance sheet. Ultimately, the company ends up with a net income of 659,000 or 1 cent per share. We've seen the trend of the EPS flip between the range of net income of 1 cent per share to loss net income per share for the past couple of years. And there's not really any consistent trend on the bottom line. But like I said before, we do see that actually the top line is growing pretty consistently over time, with the exception of a royalty buyout last year. We're not going to count that, normalizing that out. However, we move to the dividend. 8.2%, great yield, but it doesn't have a huge margin of safety in its current form, as the EPS and cash flow either barely support the payment of the dividends each quarter, or after the green bond interest payments, it is most of the time a deficit of payment. So this really reduces the sustainability over the long term of a dividend when you are not able to generate the cash or the income to cover the dividend over time. But the company does have a nice cash on its balance sheet, not a net cash position, but just cash on its balance sheet of 14.6 million. So if you want to just pay out the cash over time, you can do that for a short term. But once you're looking at the long term, 3, 5, 10 years, this is when dividend payers do get in trouble, because they're just relying on the cash balance sheet, which will, of course, slowly come down over time. So they really need either growth to support this dividend, or they would need to reduce the dividend, which is why you don't have that massive margin of safety. When you're looking at these other companies, you might only want 20, 50% of the payout. And of course, but being a royalty company, that's normally higher. 80, 90% isn't unusual. Even 100% isn't unusual for these royalty companies. But if you want any sort of growth, it needs to be lower, because it's either growth or repayments, one of the two. And right now, there's no really room for growth in its current structure. So concluding, the company is growing its financing and royalty base quite consistently, which is a positive. However, the dividend interest payments do not really leave room for growth through internal cash flows. So what I mean by that is they aren't able to reinvest their internal cash flows that they're receiving from their royalty and financing income into new operations. They need to either refinance, they need to sell off the royalty, collect on the loan before they can really put it back in. But they're not really getting anything additional once they're subtracting the dividend and the interest payments. If the company really is able to get to the point where royalties do come online and start to provide a significant portion of that revenue in the next 3 or 5 years, likely, just given the structure of how they are doing these deals, they could have internal cash flow, which then they can feed into more deals and so on. And that just is a recursive cycle, and you really get that exponential growth. That's that inflection point which you want to look for in these types of businesses. But for now, it really just has a ways to go. And that's why we want to monitor for that type of inflection point and see if it can get there for the time being.
Yeah, I think it's a good point at the end. We are looking for that inflection point, kind of when these hybrid loan/royalty agreements can start to compound up down the road, where it's getting paid more in royalties. I think that's what you would be looking for, Brett, where it would have a larger degree or percentage of the revenue actually coming in from the royalties as they mount over time. That may happen in this company, and there may be an opportunity at some point. We continue to monitor it. It may not happen, right? So we'll continue to monitor that going forward. Is that what you'd be looking for, Brett?
Oh yeah, that's definitely what I would personally be looking for. I want to see that inflection point, because then it really changes the risk reward dynamic. You'll have similar risk, but the reward goes vastly up once you see that. And that's always what we are wanting to look for, is that risk reward trade-off. You don't want to be overtaking the risk. Yeah, and that's what we're monitoring for.
Of course, like we said many times in the past, we've looked at companies for years before we actually make a recommendation, particularly in the small cap sector, where you're watching a company evolve over time, watching management to see if they're making what you would say would be smart capital allocation moves. And you know, again, there are times when you watch a company for 5 years, don't invest in it ever. You know, we had a company this fall that we interviewed management 4 to 5 years. They were sick of us, I'm sure. I'm kidding. But, you know, you go to the same events and they say, so when are you going to recommend? And we're looking for that inflection point. And if it hits, it can be really powerful for an investor. And, you know, the Vital Hub was that company this fall in November that, you know, hit that point where it was producing 10 to 12 million in cash flow on an annual basis, and we could buy it at under 10 times free cash flow. And that's free cash flow that I'm talking about for a software company that we expected to grow between 15 and 30%, maybe 10 to 15% organically, then grow with acquisition. And if you see that inflection point where you can buy it at a good price, the market is kind of forgot about the company at times, and then you find that inflection point, then you have a better margin of safety, and you have that kind of blue sky green growth potential. And like that happened with VitalHub. It was 325, it's 750 today. That's 6-7 months later. We would expect that to happen that fast, but it can happen when these companies hit their inflection point. That's why we monitor so many companies, attend so many events, interview these teams, and see if they're pointing in the right direction. We'll continue to monitor RE. Potentially in the future they hit an inflection point, and the market falls asleep on it, and we can buy some at a reasonable price with more safety.
Yeah, and go on, Brett. You go ahead. Oh, okay. You at the same time when we're talking about these inflection points, is you'll see both the underlying financials improve, so the fundamentals improve, but then the market starts to value them more. So you'll see them go from a 10 times cash flow then to a 20. So not only did their underlying cash flows double, the valuation doubled.
Re-rating.
2 is 4. There you go. And that's how you really get those grand slams.
Yeah, and all I was going to say is just we had spoken with the management team back in October of 2023, and I believe at that time, like I've written in my notes here, about 25% royalty income, 75% interest, and he had mentioned that, going forward, this should be, again, shifting more towards royalty. He gave us some percentages over the years, but again, it's whether they will hit those or not. Again, those are just targets. But yeah.
Yeah, and it's in what we continue to monitor on the company going forward. Certainly looks like an attractive yield, but we need that more certainty of the royalties becoming a larger part. I think they're trying to move in that direction.
Yep.
We'll see if it gets there, compounds over time, where they have so many royalty deals out there that are actually producing solid royalties that it does become. And then it could be that inflection point. All right. I think that's going to end our show for this week. We made it through. If you're watching this on YouTube right now, smash that subscribe button. And if you're listening to this wherever you consume your podcast, rate and review us. Like I said, always we are looking for positive reviews. Again, I'd like to wish you all profitable investing. Thank you.
Thank you.
Happy belated birthday, Canada, and thank you.
Thanks, everyone.